This is the golden question. Hello, hello. Welcome to episode 15 of the Golden Question podcast. In today's episode, we're going to be answering the question, what else can the Fed do? And the simple answer to that is really nothing. They have two scenarios that the Fed could take, but either scenario is going to be bad for the US in the short term. And what does that mean? It means it's going to be good for gold, and you could conclusively say it's going to be good for all precious metals, as well as foreign investments, foreign markets, and emerging markets around the world. And I'll explain a little bit on what these two scenarios are and why they are, regardless, going to be good for gold. So there is no losing, there is no downside, in my opinion, as of now, to own gold or to own any investments abroad. So the first scenario that the Fed could take right now is to accept that things are going to get better. A lot of people have that mentality that the Fed is going to come to the rescue and it is going to make the scenario better. But what does that entail? How is the Fed going to make the scenario better? Well, the simple answer is by injecting more stimulus into the economy, by printing more money, by increasing the reserves on banks, by continuously encouraging banks to leverage, encouraging businesses to rely on the bank's leverage and to leverage themselves. And all in all, what does that mean? It means that the Fed is going to print more money, which will, again, result in inflation. Now, this scenario is good for gold. The more the dollar loses value, the more dollars you need to buy gold, which relative to the price of gold in dollars, the gold price goes up. Now, when I stress people to purchase gold or to invest in gold, it's not really an investment in the notion that you're going to make money out of it. It's mainly a way to preserve your wealth. It's sort of a way to go against the fiat currency that's in circulation, and it's in a way preserving your wealth. Now, you're not expecting that wealth to grow, because when somebody who owns gold tracks the price of their holdings, they're not really, first of all, they shouldn't be tracking the price of their holdings, because no matter what the dollar price is, you still own that gold. You should actually be checking your holdings and see if you're continuously adding to your gold holdings, or if you need to deplete them to do some transactions in dollars. But when a person owns gold, they are doing it for the long term. They are doing it in anticipation that the fiat currency that's in circulation in their nation eventually goes bust. And in that scenario, people move to a gold, using gold, or to another precious metal. So somebody who owns gold should not look at the price, and therefore the price is irrelative to what their holdings are, because as long as their holdings doesn't change, that's all that matters. And obviously, if it increases the holdings by them buying up more gold, that is also a positive for them. So in this scenario where the Fed tries to stimulate the economy by printing more dollars, they're effectively creating inflation and destroying the value of the dollars that exist. Once the dollar goes down, you need more dollars to buy goods. So the price of milk goes up, or the price of all the goods in the economy increases, and that includes the price of gold. The price of gold increases, making the price of gold relative to the dollar go up, which again is irrelative. You shouldn't look at that as your success factor, but it is a hint that the dollar is losing value when you see your gold price goes up. But again, the gold holding stays the same. So in this scenario where the Fed tries to stimulate the economy and everybody assumes that the economy is going to recover, and then you ask them how, and they say, well, the Fed is going to come into the rescue, what they're implying is that the Fed is going to come into the rescue by printing more dollars and keeping this economy from collapsing, by making sure all these debt bubbles stay inflated, all these debt columns. And the way I look at it is a bunch of columns, right? You have all these leveraged businesses and even leveraged banks, the whole financial structure being leveraged, and it's being held up by this column that's starting to fracture. And the Fed now comes in and fills in those fractures with some silicone to keep the column from collapsing, and to keep it holding the debt based financial structure on the top. But there's only so much that the Fed could do before the whole thing comes tumbling down. And the more they try to inject to keep the structure from falling, the bigger the collapse is, the more destruction that there will be ultimately at the end of the day. And I think that's a good analogy that we could look at, or you could just simply look at it as a bubble, right? The bubble starts to expand by the Fed injecting more money into the system by increasing the money supply. And so over time, this bubble becomes so big, the walls of the actual bubble become so thin that they start to fracture and they start to pop. And some air starts to leak out of the bubble. And so the bubble starts to deflate, but the only way for the Fed to prevent the bubble from deflating is to then inject even more air into that bubble, expanding it even further. But ultimately, the larger the bubble is, when it pops, the more destructive it is. So if the bubble was tiny, right, if the column was short and we had a collapse, it's not the end of the world. But this collapse now, because of the unsustainable uh, series of events that the Fed has ultimately led up to now by continuously injecting more and more money, right, printing trillions and trillions, tens of trillions of dollars in just the past couple of months. This bubble now is the most it's ever been, and it continuously gets bigger. Every year it breaks a new record in size. So if the Fed continues on this course, it is going to be good for gold, because the dollar cannot hold. The value of the dollar will ultimately get crushed, and it could even go to zero, right? And once the value of something goes to zero, it never goes back, right? Once you get stuck in the quicksand and you get to the floor, that's it. It's impossible to get out. And that's the way I look at the dollar, right? Once the dollar reaches to zero, that's it. People lose trust in the dollar. The dollar never is going to regain value after it, bottoms out at zero. In this scenario, it's great for gold. It's great for foreign investments. You're going to see investors moving out of the U.S. economy. And again, I try to stress this out about how politically, economically, and socially unstable the U.S. is becoming. I sometimes want investors to just look at the news. I mean, watch the news and see how unstable the riots, the the amount of companies that are going bankrupt, the crime. The United States is overall not becoming a sustainable country, and it's not becoming an attractable country for investors. And also, when you watch the politicians of the United States and how they're promising to enact all these rules and regulations and all these increases in taxes, and how we're year by year, election by election, socialists are getting into power and getting further down the line into that power, getting closer and closer to the presidency, the more dangerous that is, and the more it should scare investors off, and then investors will start looking abroad. And this is why it's going to be good for gold, because investors are going to see that the dollar is not backed by this strong nation anymore, as well as the economy of the United States is no longer financially sound. And so people are going to start looking outwards. So in this scenario, if the Fed decides to continue its course, to run this course that it's been running for the past several decades, it'll ultimately lead to the collapse of the dollar, where the dollar completely collapses. And if you don't think that that'll happen in the long run, just look at it in the short term. If the Fed prints all this money, keeps buying up more and more uh, private corporate bonds, buys up more of the economy, and owns a larger portion of the economy, what does that mean? That means in exchange for that portion of the economy, in exchange for those assets, it's then pumping more and more dollars into the system, into the economy. And it's going even closer and closer to people's hands, which will then reflect in the numbers we see for inflation, which are going to be much more drastic. And we're going to see much more drastic increase in inflation over the years, or even over the months. The second scenario that the Fed can take is the scenario where it admits it's wrong. Now, this is obviously the least likely scenario, because the Fed is never going to admit it's wrong. But if the Fed admits it's wrong, the Fed acknowledges that the dollar is going to get strained. We cannot continue where we've continued for the past several decades. We cannot lift this debt-based economy up. Let's let it collapse. Let's reset the economy. Let's finally build an economy that's based on savings, that's based on real consumption from one saving, not from just debt. And hopefully, in that scenario, the economy could eventually recover. But what does that mean? That means in the short term, you're going to see an entire collapse into this entire debt based economy that we have. This collapse is going to collapse all the major markets we have. I mean, the auto market, I would say 90 to 80% of all cars bought are bought on debt. So if we see an entire collapse in that sector, that could send auto sales down for several decades in the future before they eventually recover to where they are now. But again, in that sense, they're going to be recovered to the point where people actually buy automobiles from their savings. The housing industry, right? Almost everybody now buys a house with a mortgage. And so if the debt bubble collapses there, again, the housing market is going to take a huge hit for many decades, maybe even a century, for it to fully recover to the point where people can buy a house on cash fully, and that for it to be, a sociable norm. So the economy now is so leveraged up into debt, it's so inflated with debt, that if the Fed decides to do the right thing and acknowledge its mistake and do what we want it to do, it's ultimately going to collapse. All these bubbles that it's built up, and the biggest one being the financial economic bubble, the actual banking system bubble, that's ultimately going to be the biggest one that collapses. It's going to send the economy into turmoil, and you could see riots. I mean, what we've seen in the past couple months are really nothing compared to what we will see once this bubble pops. And so you're going to see riots, you're going to see unemployment levels go to even greater than the Great Depression. And the Great Depression in and of itself is going to look minuscule compared to the depression that we will have once the Fed decides to correct its mistakes. And ultimately, this is never going to happen. I mean, we may be forced to take this scenario, we may be forced to take this decision sometime in the future, but short term, I don't think the Fed is ever going to admit its mistakes. But even in this scenario where the Fed admits its mistakes, in the short term, yes, the dollar may recover, and people might start looking back at the U.S. as a potential target for investments and financial, you can call it financial durability. But that's going to take, as I said, decades, centuries for everything to recover. But in the short term, as I said, there is going to be an entire collapse. And what does that mean? That means the dollar might take a hit because the Fed is going to admit that it's done a mistake, and investors are going to be told right to their face that the Fed has done a mistake. This dollar that they have, the Fed is going to acknowledge that it's in a bubble, right? That the dollar has been built on just a bunch of debt. That's where most of its value comes from. That there is no actual real value in the dollar. And so even in that sense, it may lose tremendous amounts of value. But in this scenario, the dollar may not zero out. It may get really, really low. But once the U.S. starts to recover, despite it taking a while, it may take, again, several decades, half a century, maybe even a century, the dollar will hopefully regain value, and that is the ultimate goal. But in the short term, it is going to be good for gold and foreign investors. You're going to see investors evade the U.S. You're going to see people buying gold at a much more volume, and people even just moving to gold in the U.S. all around the world once they realize they don't have to rely on this dollar anymore to transact, to use, to purchase their own goods, to purchase other nations' goods. And the dollar as the world reserve currency will inevitably collapse, and we will lose that status. So in that scenario, in the long term, yes, the U.S. will recover because we admit our mistakes, and we will try to rebuild the economy by collapsing the current one and rebuilding one that's based on actual savings. But even in that scenario, that is only the long term, 50, 100 years. In the short term, it is going to be bad, and it is going to be good for gold and foreign investments and foreign markets, as well as emerging markets. So I've just portrayed to you two scenarios, and no matter which one you look at, it is going to be good for gold and for foreign markets and foreign investments. no matter what scenario you look. So anybody who tells you, don't worry, the US will recover, and that means you don't have to buy gold. How will it recover? Will it recover by the Fed printing more money? Because in that sense, you could say, wait a second, that's inflation. That's the dollar losing value. That is great for gold. Or somebody could say, you know what, don't worry, the Fed might actually admit it's mistake, although there are very few who actually, have this argument for the economy recovering. But you could have one individual who says the economy will recover, the Fed will admit its mistakes, and we will go back to building a strong, durable, financially sound economy that's actually built on savings. But even in that scenario, in the short term, you're going to have to collapse the current state in order to rebuild a new one. So hopefully, if I've explained to you the two options that the Fed has to take, the one option being the easier option, but still being good for gold, and one being the more challenging option that is going to be good for gold in the short term, but in the long term, obviously, that entails for the U.S. to recover. But it's still a great opportunity for gold in the short term. Maybe in the up until maybe 50 years from now, it'll still be a great option for gold. So this is what the Fed can do. The Fed really has no option. I mean, it looks to me, it appears to me that its hands are tied. They can't really push this bubble anymore. The bubble can only get to a certain size before it pops. I mean, and you can't really expand it from that size. There has to be a limit to how much this bubble can expand. And the more it expands, it is going to be great for gold, because that means that the dollar is going to start to weaken, and we have already seen it weaken over the past year. So the more this bubble expands, the greater the better it is for gold, because that means that the dollar is starting to lose value. The walls of the bubble start to become very, very thin. But even if the Fed decides to let this bubble pop, it is still going to be great for gold, because you're going to see an entire collapse in the U.S. market. So hopefully I've explained to you both decisions that the Fed can take, and why I think both in any scenario are going to be good for gold.